Hey everyone, welcome back to Collecting Compounders. My name is Sousa, Associate Portfolio Manager at Marnoa Private Wealth. Let's get right into it. There's a lot of criticism that the Fed is behind the curve and acting too late and too slow when it comes down to loosening monetary policy and reducing interest rates. At last month's Fed meeting, interest rates were left unchanged in a range of 5.25% to 5.5%, a level maintained since last July. In May, the Fed said it will take longer than previously expected to gain enough confidence about the trajectory of inflation to start cutting interest rates. But at the July Fed meeting, that language quickly changed to, and I quote, "A reduction in the policy rate could be on the table as soon as the next meeting in September." And of course, that is depending on if the economic data supports that decision. So did the Fed make a policy mistake by not cutting in July? By 50 points or at least 25 points. The case is therefore a rate cut. Inflation has come down a lot, inching closer to the 2% Fed inflation target. The Fed has done a good job in that regard. We could see a rate cut at the next Fed meeting on September 18th. Well, that's what the 30-day Fed fund futures are predicting anyway. The Fed fund future traders are pricing in a 55% probability that the Fed will cut interest rates by 50 points by September, according to the CME Fed Watch tool. So why should they cut rates? U.S. corporate earnings have generally been good. However, recent economic data like manufacturing and the labor market is beginning to show signs that the overall U.S. economy is cooling. ISM Manufacturing PMI, which basically measures the level of business activity in the manufacturing sector, that dropped to 46.8 last month from 48.5 in June. And that is the lowest print since November. The latest U.S. jobs report showed that only 114,000 jobs were created in July, while the expectation was for 175,000. Also, there was a big downward revision in June payroll gains from 206,000 to 179,000. So that's signaling to us that the labor market is cooling but remains stable. The unemployment rate rose to 4.3%, which has risen from a 5-decade low of 3.4% in April of last year. It's important to point out that the labor force participation rate has been increasing, and that could possibly explain the increase in unemployment rate. It could be signaling that more people are joining the workforce and increasing the pool of unemployed workers. Nonetheless, stocks sold off on both data points. Now my question to you is it too late for the Fed to act? I don't think so, but it makes sense to cut sooner rather than later. We don't want a situation where the economy materially softens and then the Fed starts to cut. It could be too late then. The risk that the Fed might cut rates too late, as they did in 2007, is a valid concern. By the time the Fed started to cut rates, the housing bubble already had burst. Defaults on subprime mortgages were rising, and signs of a banking crisis were emerging. If the Fed delays rate cuts or does not cut rates sufficiently in response to a softening economy, it could result in a situation where the easing measures are too late to prevent a recession. No one really knows how many cuts or how big the cuts will be. It's a slippery slope. If the Fed cuts too cautiously, they risk a recession. And if they cut them too much and too early, they risk fueling inflation. It's quite the delicate balancing act. Jerome Powell, he will be speaking at the Fed's Jackson Hole meeting later this month. The market will be looking at any hints of a potential rate cut in September. Rate cuts materially favors fixed income investments. We have been allocated to short as well as long duration bonds to client portfolios. And that has been performing very well with the pullback in yields in Canada and the US as of late. We expect bonds to perform well going into next year on the back of easing monetary policy from both central banks and lower inflation. Everyone is talking about Japan and the yen carry trade, which led to a broad market sell-off and a major deleveraging event. In the global financial markets, you have different borrowing costs, and you can borrow in different currencies. With a carry trade, an investor borrows in the currency of a country with low interest rates, such as the Japanese yen. Japan has historically had very low interest rates. You can borrow the yen at basically zero because Japan has kept rates ultra low to negative. The borrowed proceeds are then used to buy higher yielding assets in other markets, such as the US, where interest rates are much higher. Profits are made from the interest rate differential between the borrowed currency and the invested assets. This right here is an example of the yen carry trade. In the yen carry trade, the investor borrows Japanese yen at relatively low interest rates, converts proceeds to another currency such as the US dollar, where the funds are invested at a higher interest rate for a term. At the end of the period, the investor exchanges the dollars back to yen to repay the loan, pocketing the difference as an arbitrage profit. If the currency rate at the end of the period is roughly the same as when it started, or the yen has fallen in value against the dollar, the investor profits. However, if the yen were to appreciate versus the dollar over the same period, the investment may result in a significant loss. The yen has been a popular funding currency because of the Bank of Japan's zero-rate policy. The Bank of Japan has held its policy interest rate at an ultra-low negative level for many, many years. But that recently changed as the Bank of Japan increases interest rates to about 25 basis points from a range of 0 to about 1 basis point. The recent rate hike by the Bank of Japan, combined with the appreciation of the yen, led to a significant unwinding of the yen carry trade. This resulted in increased market volatility and a substantial decline in risk assets globally. Remember, the carry trade relies on borrowing, which means it's a leveraged position. Once losses begin to accumulate, lenders will require the investor to provide additional funds to cover potential losses. This is a process known as a margin call. A margin call may force the investor to sell stock or closing out positions completely to raise cash to balance the account. And now when I say investor, I mean hedge funds, not the average retail investor. Hedge funds are the ones performing the carry trades. The unwinding of the carry trade, the margin calls, among many other things, led to a deep sell-off across the global markets. So should you panic sell? Is the yen carry trade a good reason to sell and get out of the market? The hedge funds are being forced to sell stocks to meet margin calls because they're the ones employing a very risky strategy that uses leverage. Now, why would you join them and sell your stocks? Why would you sell a great company like Amazon or Microsoft on news like this? You're not the one having to meet a margin call. One needs to be disciplined and stay invested during times of market volatility. Market sell-offs are a normal part of the market cycle, and we've been here before. Investors experience market pullbacks more frequently than they are likely aware of. 5% pullbacks occur more than 3 times a year on average. 10% pullbacks occur more than 1 time per year on average. 15% pullbacks occur every other year on average. And lastly, 20% pullbacks occur every 3 to 4 years on average. This chart is from JP Morgan. The chart is as of June 30th. It shows the S&P 500 intra-year declines versus calendar year returns. On average, going back to 1980, the market has intra-year drops of 14.2%, but annual returns were positive 75% of the time. If you look at the most recent market peak of the S&P 500 set in July, the market was down 10%. While the recent market volatility was very sudden, it's not out of the ordinary. And here's another stat. About 94% of the years since 1928, we've experienced a pullback of at least 5%, and 64% of the years have had at least one 10% correction. You get the point. We've been here before. Looking ahead, we will likely see choppy trading and elevated volatility through the course of the summer, as we wait for more certainty around economic data, the direction of the Fed's interest rate policy, and the outcome of the U.S. presidential election. We are also entering a seasonally weak period, with August typically flattish, followed by weakness through September into early October. As always, we continue to monitor economic developments and remind ourselves that periods of volatility can present opportunities to identify and buy quality businesses selling at a discount. Anyway, I'm going to hop off. Thank you for watching and listening. Don't forget to hit the like button and subscribe for more content. Bye for now.